Thanks, everyone. Great to be here. And I heard a lot of talk about why do we do this. I hope the slides that I put forward don't depress you even more of why do we do this, because we are going to take a journey. We are going to take a walk through data. We're going to try to make sense of numbers, and there's a narrative there somewhere, and we're going to see what it means for the venture asset class in the end, and why are we here, and why do we talk about prosperity so much? So I really wanted to start about, as we were thinking about what we do, we're this whole room full of dreamers, disruptors, businesses, building really exciting things. But let's just, for 1 second, understand the world in which we inhabit, and that's the kind of prologue side of what I'm going to talk about. And there's a reason for that. And actually, it's quite personal. Sometime in 1992, there's a person who I know well, ran about 100 meters in 13 seconds. And he felt on top of the world. Felt like, yeah, I think this is something I can do quite a bit. That is me back then. It's a very dashing young guy. But then, until I benchmarked myself many, many years later, and I actually saw, well, it doesn't matter, 13 seconds, 14 seconds, because the best sprinters at that point of time were really killing it when they were much younger, right? And I was just nowhere in that. So that completely destroyed my chances of ever thinking I'll be a world-class sprinter. But I'm still here. There's no redemption arc at the end, okay? I'm not going to talk about something else. But it was very, very important to figure out our kind of space in the world. And so that's what I wanted to contextualize. How big is this asset class of venture that we talk about? It's quite tiny. Actually, it's really, really small. If you look at global private capital funding that's happened, the global dry powder, you see those small green lines? That's us. That's the place we inhabit. And that's where most of the money comes from globally. And this is an interesting graph. I see this almost every year because this talks about how do we perform. We are that small little square in purple. And the stats that you see there are essentially how the venture asset class performs year after year. Sometimes we're on top, sometimes we're absolutely below US core real estate and natural timber and transportation. Sometimes we're the best thing since sliced bread. But it is a very, very volatile asset class. It is hard to do this, right? And we're all over. But who funds all this? Who funds global venture? And if you think about the average percent of VC fund allocation from LP groups, it's largely pension funds, endowments. Now, these are extremely smart people, you'd think, all of which are very, very liquidity sensitive. They have obligations. They have to pay back at regular annual payouts to pension holders. But they've started increasing this asset allocation over time. So it's getting riskier. If you have a pension in the Nordics or in the UK, you're exposed to some really, really hairy stuff. But the interesting thing about this is, it's really, really hard for these allocators to even identify us. This is a very interesting chart. It talks about manager dispersion. The top decile managers, the worst performing managers, how would you perform? So this is interesting. From 2012 to 2022 was boom time. I could literally throw a dart on the board and pick out a winner in the venture asset class. It's fine. Everyone was easy. Everything was fine. But you fast forward, and that dispersion completely starts to compress. You can't throw darts anymore at the board. You're not even performing really, really well for the risk that you're taking. So it starts becoming very, very difficult. I'd rather stick to bonds or private credit. And that's how hard this asset class then kind of comes. And so, that was to contextualize where, the world we inhabit and why that was important. But let's get on to the state of the market. This is a very interesting chart, I feel, is best to start with, because this is, exactly the kind of things both venture capital funds and founders think about. How much money do you need? So this is a global average. It takes about 10 years, if you kind of go through this chart, to go from seed to Series D. It's taking much longer these days than it did earlier. You need at least 70 to 100 million to get there. So this is like a global average. Obviously, there are some companies who do it much quicker. There's some companies who need a lot more capital. But it's very, very important from a capital allocator's perspective to know how much of money is needed. We talk about liquidity later, but this is, the inflow. And what has happened over time, that it's starting to become more riskier. The whole venture asset class, if you think about graduation rates, they're at an all-time low, which is from seed to Series A to B, B to C, C to D. They're all kind of getting riskier. They're all getting longer to kind of also raise rounds. It takes about 2 years now between funding rounds. So people have started to become a lot more careful about how much you raise, when you raise, how much cash to conserve. So I think we're in a period of much better self-reflection than we were quite some time back. It is getting lonelier to run a business. Solo founders are stepping up all across the world. The data suggests that. Although, interestingly, multi-founder teams tend to find a lot more success in raising capital. So it's a very, very interesting phenomena where you'll start to see a lot of solo founders joining up later. We see this all the time. Founders who were not there in day one, day zero, but kind of get the founder title a bit later. But you're starting to see an emergence of that. And we see that across Africa as well as in Asia, across in our markets. Another interesting stat that I found was that if you build a physical product, you're starting to see more founder team dilution. Interesting, because they're largely more capital intensive. They rely on R&D. In some cases, it's actually better to raise capital than higher dilution. But that's something we're seeing between digital and physical kind of models. And as we're seeing a lot more funding in climate, that's something we starting to get a bit more conscious about what does dilution mean in such asset-heavy businesses, R&D businesses. But it's been a massively tough ride globally. About a fifth of VC tech companies are not growing, not profitable. So these are late-stage investments which have happened. So there's a lot of illiquidity in the system. There's a lot of indigestion with funds. But the VC fund manager landscape is not great either. There are fewer funds surviving. The funds raised during global financial crisis had the lowest survival rate. So it gets lonelier as a capital investor as well. And I promise you, I didn't put Comic Sans as the font. I think it got changed later, so I'm not being funny there. But you're starting to see the survival rate of your capital stack is also kind of decreasing. And this is leading to a very interesting place where there is a differentiated risk profile and underperformance between small and large funds. And this is a massive phenomena the world over, and we are starting to see this in our markets as well, where smaller funds are kind of doing much better performance than larger funds, even where things are not going well. And persistence rates are looking steeper. Now, what is a persistent rate? It's something LPs, allocators look at when they think about backing fund managers subsequently. Is this fund manager going to perform again and again? Is performance going to remain? It is harder. So what worked in a prior fund may not work in subsequent funds. But what we've realized is once you do cross that, once markets develop on their own, you start to see a very, very intriguing cohort come out of brand names, founders wanting to be with these funds, and it's a virtuous cycle that kind of goes on. But the point here is it is hard. And guess what? It takes 7 years for an LP to realize what actually the portfolio looks like. And here's a very interesting stat of, if you look at all across asset classes, at what period of time do you actually settle into a quartile ranking? And you'll see, 7 to 9 for venture capital. What I found interesting about this chart is private natural resources, you actually figure out faster, which I found a bit odd because I thought, trees take a long time to grow. So that's a bit of a odd one there. And a lot of what we see in most of the funds are largely driven by unicorns. They hold 2/3 of the market value of these VCs, and about 40% have been held at that same for about 9 years. So you see the groundswell of all this asset growing into books, liquidity being a problem the world across. So what's happening globally is also getting differentiated. And where better to look at than in the US, where we're seeing a completely different shift in the asset class, massive amounts of concentration, massive asset bubbles coming up, lots of creative destruction happening. So let's spend a bit of time to understand what's happening there. And I really then want us to come back to our markets and kind of see if there's a story here. So this is what I've been hearing. It's different this time. It's AI. It's different. Everything's going to change. But when you actually start looking at what AI does, there's a lot of hallucinations. That's actually a real quote there on the right, where you can actually trick AI to thinking you're wrong, and they'll be like, oh yeah, sorry, I'm wrong. That's what we're spending billions and trillions on, right? So it's all great, but I'm saying we've seen this story before. We've seen Meta and other such great inventions. It's also the biggest thing ever. If you look at some of the capital expenditure from all AI hyperscalers, it's mad. In terms of even operating cash flow from some of the largest companies in the world, it is growing. So it is also seismic from their perspective of what they're building. Yes, there are lots of benefits that we're going to see from this. There's probably things we'll see in terms of labor productivity in the US, at least. But we are starting to accumulate a lot of physical assets. It's also the most transparent. This is an interesting chart of how capital revolves in the tech ecosystem in the US. Lots of money going here and there. Nobody knows where exactly, who's contracting to what. So it's a very interesting article on Morgan Stanley and the FT about how the circle of AI just revolves around its own ecosystem. So these guys are playing their own game out there. Obviously, VCs can't be left behind, right? It's exciting. They've started to grow their AI book significantly in the US. It's about 71%. Most of the VC deals are now AI. You just have to show up with an AI slide, and you'll probably get funded there. Fun fact, any company which has a .ai in the end, did you know it's actually a country code for Antigua? It doesn't actually mean artificial intelligence. So, but that's happening, right? Everyone's on this hype train. And tech companies are actually looking a lot like utilities. If you look at the Mag 7, the Magnificent Seven, right? Meta, Alphabet, Tesla, they're all turning away from being software companies to actually getting into asset-heavy businesses. They're looking a lot like what an AT&T looked in 2000, what a utility looks ahead. And this whole infrastructure capex that we're seeing globally is about 20% of the peak at what railroads were built back in time in the 1880s. So there's a lot of repeat of this. I think one difference here, and it's quite interesting, is unlike railroads and telecoms, which are long asset capital formations, AI data centers, especially chips, would probably last for 3 to 4 years. So you're also building a very rapidly depreciating asset, which you'll have to change again and again. So just have a think about that. So, that's the quantum of stuff which is happening out there. And venture capital are now investing like buyouts. So there's this entire bifurcation in the entire VC world which is happening. And that's why I started with some high-level thoughts on where venture is. Venture probably is not going to be venture of what you and I know. It's no more going to be a cottage industry. You're starting to see mega rounds kind of increasing concentration. You're starting to see multi-billion-dollar VC funds being raised. A lot of the LP capital, the endowment capital, is getting sucked into these funds, whether it's an Andreessen, whether it's General Catalyst, etc. They are playing a very different game. And I keep hearing about, well, how are you going to return 5x of a 10 billion fund? Because you'll need a lot more unicorns for that. Actually, I don't think they're underwriting for 5x. I think they're underwriting for 1.8, 2x at max. It's SOFR plus a percentage. Because it's a very, very different game. The asset concentration, which is happening the world over, is something which is fundamentally changing this space we inhabit, this nice asset class that we've been talking about, venture capital, very idiosyncratic, very village-like, very collaborative, is becoming now something very, very different. So so tech companies becoming like utilities, VCs becoming like buyouts, there's something really different. It is becoming massively stratified. And it is what I call inequality in fundraising. You're starting to see, the bottom 90% really, really struggle hard versus the top 2%. And larger funds are deploying more per deal, paying more per company. They're very, very insensitive to what they pay. And so it's becoming a very odd behavior in the market that we will start to see. So that's what I spoke about. Concentration is ironically becoming the buzzword in venture capital, which is all about diversification. So who do you think pays for all this? We all do. We end up paying for cloud compute. So on an average, every software business pays about 50+% in cloud revenues. There's Google Ads cost that I'm sure a lot of you founders are aware about and not happy about. And obviously AI. Do you really think all of these people are building AI capabilities to make the world a better place? No, they want a return. They want a return, and if you're thinking about even 10% returns, that cost is going to come back to you. That's going to be sold to you, which is great for software companies, but that's the cost that we are all going to bear one time or the other. So again, something to really think hard about. I know there's some really interesting statistics in the Indian venture ecosystem where somebody attempted to figure out, of all the dollars that have gone into startups, how much has actually gone outside the country by way of cloud, by way of AWS, by way of all these other things. And so, what are we really, really building in these markets? And that was, an interesting shift in this venture model. So where we are now, we are going into a place of de-risking to re-risking. This is a very interesting concept I read upon, where if you think about the regular risk progression in venture capital, you have early VC, you take risk, you progress, then you have late VC, then you have private equity, and then so on and so forth. What we're seeing with mega fund VCs is you're almost shifting and re-risking this dynamic. You're raising early capital, over-capitalized. You have another VC fund, another global endowment kind of come in and put a lot more capital, shift the entire business model, and that's what you're starting to see in these markets. You're starting to see bubbles erupt in the private credit side. There's a lot of debt capital now starting to back AI, data centers and all that. So you're just adding a lot more risk at very different levels. So it is a re-risking element that we're seeing in our markets. So when we're faced with this, I think we should spend some time, rethink norms, and I'm glad that all of today we will be talking about these topics in much greater detail. I'm really excited to hear, and everyone should contribute about, let's rethink what's happening if we really want to invest in prosperity. If you're a VC, you should really think hard about fund sizing. I mentioned there's a stratification going on. There are mega funds out there right now. You will not be able to compete. But do you really want to compete? Because if you really want to make returns, you should think hard about what is your fund size, because that is your fund market fit. Your fund size is your strategy in the market. Nobody remembers your AUM. Everyone remembers your money multiple out there. How much did you make in your last fund? I made 6x, I made 10x. No, I don't even recall how much any of the fund managers raised. Because that's where we're coming back to, right? Pure returns. And I think you have to think very hard. It's some really good data points about when you're a smaller fund. And I don't mean we should all be raising micro VCs. I mean we should really think hard about what it means. There's a lot more data that has started to come out on vintages across all fund sizes. And you're starting to see top decile IRRs in smaller funds tends to be a lot higher. Obviously, the math works. Smaller funds need to generate fewer returns to produce the same multiple. So, there's some really good data on that. Also, this is a very interesting piece I came across, the rule of 32. Just multiply a fund size by 32 to determine the exact required total exit value. So this is a thumb rule. And the reason you have that is to figure out how much of exits do you need. And I think Kola had some facts up on the board to how much exits do we need if capital goes in, if you have to return at the same target that you want to get up to. So think about that. Think about the reality of the market 5 or 6 years down the line. Think about reserves. This is another interesting point. There's no easy answers on this. Do you invest pro rata throughout? Do you have no reserves, just go all in, what we call high conviction investing, all in or nothing? There's a lot of interesting research. There's a lot of interesting data points out there which actually prove it's probably not always the best if you just keep reserving. Because what we've seen is you can also follow on badly. We've seen a lot of examples of people putting good money after bad. And so you always have to think, shall I go in up front or rather wait for later? There's also a secondary benefit. If you really are in a winner, that price is, as I mentioned, things are getting more concentrated. They're starting to get a lot more costlier for you to invest and take pro rata stake in. There's a lot of data there about whether you concentrate the winners. It's a heavy slide, so you can read at your leisure later. But whether you spread or you missed the first one, what happened? So think a lot more deeply around this area. Like I said, some of the top performing funds don't actually have high reserves. Now, are they just doing that because they have the best access? Probably. Are they lucky in some vintages? Probably. But there's something out there which is making us kind of rethink that. The other point a lot of fund managers and LPs talk about is even a 10-year fund term realistic? I mean, just look at the data and you start to see medium distribution, unrealized value. There's absolutely nobody globally who returns this in 10 years. Very few. And you're also starting to see a lot of time between funds of the same date. So what are we doing to this whole 10-year fund cycle? Now, don't get me wrong. I'm not the one advocating for, just because we don't have returns to get a permanent capital vehicle. I'm not saying you just have to keep extending, because what a 10-year fund does, it keeps you disciplined. It's the product, right, that you're selling. It's what says on the tin. But if it is going to be more than 10 years, if to stick with 10 years, but returns are going to come after later, should we be rethinking some other sacred cows? Should LPs rethink hurdle rates? Why are we so fixated about having hurdle rates on venture capital funds? This is a global study where you've seen actually about 40+% globally are not on hurdle rates of 8%, 10%, 12%, whatever there is. Maybe we move towards tiered carry. And there is a very interesting argument for that. Because if we know, and the data says that companies are going to take longer to IPO from seed, funds are much longer than 10, are we just making the problem much harder for fund managers to earn carry? Are we fooling ourselves that we have to get money back much faster? Are you just keeping TVPI on the table just to deliver DPI? And these are things we have to be very, very thoughtful about. It's a different asset class, and I think capital allocators also have to do a bit of thinking around that. And remember, higher fees also means you have a higher bar for performance. So you may be a small fund, you may be justifying a higher fee, but guess what? If you move, it's a very interesting kind of factoid across years, if you start increasing your fees, the amount that you have to deliver increases. Again, this is pure math, but your performance bar just goes up. So you can get lucky ones with high fees, you can try doing that. But remember, fees are a loan from your LPs to run a fund. It is not something for you to just enjoy with. It is a loan from the LPs, and currently I think the entire market is quite indebted to this. So you have to really think about what is the right amount of fee set, what is the right, from a GP perspective, to think about it, because like I said, the world is changing a bit. But all's not gloomy, and I think we should try to look at another ecosystem for clues. And I think when Doton and Kola said, look, let's talk about, the US does its own US thing. What about other markets that have been slightly more advanced? What are they doing? Are they any different? Here I'm going to talk about India. It's not as different as across Africa. Lots of different states, lots of development challenges in the country. You go to Delhi and you'll be mistaken to see it's just like Lagos. The vibe, the enthusiasm, the chaos, everything exists. And the good thing about it, it's not just AI. So this is India venture capital spending investment by sectors. But what I wanted to point is a large part significantly still goes to traditional sectors. Consumer, banking, financial services, all driven by large addressable markets. There's so much of growth opportunity to serving the bottom of the pyramid. It's very, very similar. And it's not as different to what we see in other markets. Obviously, the numbers are larger, but my point here is to say, here's an ecosystem which is doing, I think, spending. A lot can be done better, spending exactly where the needs are, which is what I feel we're doing in Africa as well. And India is not just one economy. There is a very, very different kind of set of India. There's a very different set, even if you go across states, about income levels, about aspirations, about people's education, and you can address all of them very, very separately. And I think that is the richness that developed markets have in common, the global south has in common. Very, very similar problems. India VC is also not Bangalore. And this may come as a surprise to some, not to others, but it is not Bangalore. It is spread out. It is, everyone's thinking, Bangalore is all IT. No, it isn't. It's actually going down a lot. Most of our portfolio visits, when we do in India, is now Delhi, Haryana, Mumbai, other states, and it's spreading wider. So, that's one great thing that we're seeing in the market as well. But an interesting public market story has emerged over some time. And I'm going to dive into some super interesting facts around that, which some of you may not know. So on the chart on the left is about how many IPOs got done in 76, about 76% in 2024 as exits. So large IPO activity happening there. There are about 20 venture-backed companies, publicly traded, across 8 verticals, with about 120 billion market cap, which has been listed. And it's so interesting. Most of them are getting priced on growth. The chart on the right, the S&P BSE mid-cap, which are listed mid-cap stocks, you can clearly see the premium that some of the listed startups are getting just on revenue CAGR. That's what the market is valuing at 1.3 times to be exact across growth. That's what the market is valuing it at. There's a very large pipeline of companies coming to market. So this is some good stats around, all focused on top line, growth, profitability. There are about 38 late-stage startups valued at about 1.9 billion, raised a lot of money, growing extremely fast, 40% revenues, real strong EBITDA profitability improvement, and offering much better metrics. So see, the quality of the assets coming through the pipeline is also stronger. And that's what people are starting to get a lot more comfortable with. But the most interesting thing is happening in the country. A lot of startups which were established in the US, Singapore, outside, are now re-domiciling back to India. And it is costly to re-domicile back. You have to pay a one-time charge, but that's happening a lot. And I think that's a really, really interesting aspect. But this is a 10-year story in the making. It just didn't happen overnight. Those are the VC funds who backed this innovation we're talking about. And about 80 to 70% are domestic funds in India. They're not, just global funds backing. There is a massive family office cohort, about 20% that backs venture in India since 2017. So local capital, really excited. But the most important thing, and this is something we should be talking about a lot more, is the government. The domestic government fund-of-fund ecosystem is strong. It's about 1.25 billion, backed about 144 VC funds, who in turn raised about 8.5 billion externally. And now that program is doubling to 2 billion. Again, India is not, a developed economy. It has its own insane problems, current account deficits, governance, blah, blah, blah. But I think they're really laser focused on this. Something's going well. But it's also retail participation, which is interesting. There's about, if you look at what Indian retail investors do, they would invest about 400 million a month in 2016, which just massively went up to 2.7 billion. These are automatic systematic investment plans. These are what you call SIPs. So retail participation in the markets has also driven quite a bit of this growth. If you look at the domestic institution investors in India, that's outpaced foreign investors. And that's very, very important for an economy to be self-sufficient. So it is taken a long time to get there. So, when we talk about this, I think we should think about where we are, what we are at this point. And that's why I wanted to, touch base a bit on what's happening in the globe, what's happening in the US, what's been the story in India. But how can we, as an asset class, be a bit more consequential in what we do? We need to really think about being non-consensus. We need to think about being bold, collaborative. And I think these 3 points are probably the most simplest things out there. But we need to really solve for that. We need to know capital needs a return. It needs to be channeled. For that, you need to build opportunities. You need to identify them. You need to fund them. So, that's what VCs do. That's what allocators do. But you definitely need policies to incentivize the growth. You need policies to kind of promote inclusion. I mentioned systematic investment plans. It's now $3 a month. So even if you're a taxi driver in India, you can invest in mutual funds and take part in the equity story. You need to get to that level of capital formation domestically to really build this thing that we're building here. But all about this innovation, and I loved the fact that, Kola, you mentioned about the people and planet earlier. It's all about the people. Let others do whatever data center stuff they're doing in the US and AI, and that's great. Thank you for building that. We'll pick up the pieces when things crash. But you have to really figure out, Africa is going to be the largest kind of working age population. We need to build things for them. We need to kind of think about their consumption patterns. We need to think about what are we doing on a day-to-day basis, and are we building businesses to do that? Some of the most successful entrepreneurs in the continent have built on that. We need to think about the planet, and it is getting hotter, and these are going to have a lot more effects just aside from sweating, to things around crops, to things around food security, with the climate. What are we thinking about that? If you go to Delhi now, and the AQI is about 300, 400, you just hate being in that city. It is so polluted. And I think somehow some people realized and started really building passionately about the EV mobility ecosystem there. And now you go there, you'll see tuk-tuks and small autos all running on EV. Did they do it because some VC came and started funding it like Tiger Global? No. They did it out of self-interest. They did it out of policies that build. So we need to really start building for things that have consequence to our daily lives. This is an interesting point I read, thanks to friends from DFS Labs. You should read up on it. It's, S-curves about African innovation. So when you think about standard S-curves, these are innovation curves, it takes significantly longer for African markets to shift from one to the other. But interestingly, what that article also states, that founders have found that this can be much, much more steeper, and the movement can be a bit more dramatic. I think we have to really understand these fundamental things about the market we operate in. There are businesses which have exactly played on this S-curve. You have companies like Moneypoint, which has captured this insane surge of growth for people to need capital for growth, but to also transact. We have so many businesses around sitting here today which have identified. But I think that's something we need to really get stronger on our frameworks on to realize what it is. But we talk about returns and liquidity, and I just wanted to put this into perspective. African tech has actually returned capital from its first wave. There has been, and we've seen this in other markets, that it's been so, we're not in this dire situation of illiquidity. I spoke a lot about that, but we have returned, and it takes time. But when they happen in great numbers. And I think we just need to keep moving this story forward, keep talking about all the good things there. But we're starting to see another theme emerge, which is this whole, what is an African tech company, actually? Some great facts from our friends at Brighter, which spoke about companies operating cross-regionally, raised mega deals across, African founders, African companies, but going global, having global aspirations. So I think that's really, really interesting thing to think about, because perhaps that's something which gets other investors excited as well. But I think finally, the one thing I want to really, really talk and get home, get this to home, and again, data from our friends at Africa, is who funds this and who participates in this economy. The chart on the left-hand side kind of talks about investors participating in deals. It's largely international investors. In an ideal world, you don't want somebody talking about global venture capital. You want domestic folks kind of talking more about this. So let's flip that, and let's try to get a lot more domestic capital. I spoke about how that's working in other parts. In India, for example, let's really increase, chart on the left side, kind of get more from sovereign wealth funds in the region to invest in Africa. Because we cannot continue to keep having cyclical capital come in and come out. So that's kind of the thing I wanted to end with, but it's an interesting ride. I think we have to start becoming a lot more thoughtful around what we're building. But we love the fact that we have such an exciting turn of sessions today to talk about all these things. But yeah, feel free to reach out if you want any slides. But thank you.